Informed Choice Radio episode 426. What's happened to Neil Woodford?
Recorded live from Cranleigh in Surrey. This is Informed Choice Radio. Want to make the most of your money and your life? You've come to the right place. Here at Informed Choice, we believe that when it comes to your money, the more you know, the faster it can grow. Now, here's your host, Chartered Financial Planner, Martin Bamford.
Hi, Martin here. A bit of a different one this week. I'm not going to go through personal finance news and the after show and all of that as usual, because we're going to be talking about the big story of the week, the only real personal finance story this week, and that is Mr. Neil Woodford. Now, it's been a really busy week for the financial press, but probably for all of the wrong reasons. Neil Woodford's £3.7 billion fund, his flagship UK equity income fund, has suspended trading following high levels of withdrawals and some liquidity concerns. So in this episode, I'm seeking to make sense of what's happened to Neil Woodford, unpicking, I hope, some of the key lessons from this really big investment story. Let's start then with a little bit of background. Neil Woodford is one of a handful of so-called star fund managers. He's been heralded for his decades of superior investment performance. Investment fund managers rarely pick up that star title. There's not very many of them. But when they do, it's often then used as a marketing tool to accelerate the profile of the manager and attract new investor money to their funds. Woodford's star first rose when he was an investment manager at Invesco Perpetual. He moved there in 1988 and he became responsible for their Invesco Perpetual Income and Invesco Perpetual High Income funds. They had a £10.3 billion and £13.6 billion of assets under management respectively. So big investment funds. These funds, along with his institutional investment mandates that he ran for other companies, performed very well relative to similar funds in the same sector. And towards the end of his tenure with Invesco, he managed around £30 billion of investor money across his various investment funds and mandates. Back in 2012, when the press were fawning over Woodford and his star fund manager status, one newspaper reported on his performance with a headline that said, Neil Woodford turned £10,000 into £114,000 in 20 years. Can he do it again? And then in April 2014, he left his role as head of UK equities at Invesco Perpetual and he left to establish his own fund management group, and that was called Woodford Investment Management. At the time, he launched the LF Woodford Equity Income Fund. And a year later, in April 2015, he launched the Woodford Patient Capital Trust, that's an investment trust, and that set a new record for the largest ever fundraise by an investment trust, £800 million of subscriptions. The investment trust invests in small and unlisted companies, and it became a feature of his original fund, that approach. But the original fund had a 10% cap on non-listed stocks. I'll explain why that's important in just a moment. And then he launched another investment fund in April 2017, the LF Woodford Income Focus Fund. According to an interview for What's Investment magazine at the end of March, Woodford believes that being an active investor means doing something different from the market and adding value through the investment process. It is also active in engagement with company management teams to help understand the long-term aspirations of the company. Its long-term approach to investment management is encapsulated in a patient capital investment style. In the same article, he addressed criticism of recent poor fund performance, reflecting on the challenges of taking a contrarian approach to investing and saying, certainly I've been on the receiving end of a lot of criticism in recent months and it is incredibly uncomfortable. It's not just uncomfortable for me, it's been uncomfortable for the business around me and everybody who supports me at work. It has been a really challenging time. But he stuck to his guns, believing his strategy would continue to be proven right over the longer term. And then this week, the big news, trading in his largest fund, the Woodford Equity Income Fund, was suspended following large withdrawals by investors. Things started to turn negative for Woodford following the EU referendum back in 2016. He took the view that British stocks with prospects linked to the UK economy would recover in value, but that play seems to be taking longer than he expected. Rather than the value stocks bouncing back, it's been growth stocks driving market returns since the UK voted to leave the EU. This call to back British value stocks has resulted in a 27.6% fall in the value of Woodford equity income since its peak, which was reached in June 2017. There's also been some specific stock-related issues within the fund, and that's prompted some of his major backers, like Jupiter Asset Management, to pull out. Woodford was forced to sell his holding in the pension provider and investment broker AJ Bell as a result of a growing weighting within the fund, the rest of the fund, to unlisted stocks, and that turned out to be bad timing. AJ Bell later announced its plans to float on the stock market, actually shortly after he disposed of it. With more investors disappointed with the performance of the fund and withdrawing their investments, Woodford took the unusual move earlier this year of transferring some unlisted stocks from the investment fund to the investment trust in return for listed shares held in the latter. And in another unusual move, which followed slightly afterwards, Woodford listed some of his shares in unlisted companies on the Guernsey Stock Exchange, and that raised a few eyebrows. His fund, once valued at £10.2 billion, had fallen in value to £3.7 billion. He was forced at the start of this week to suspend trading in the fund, and that's to give himself time to sell the illiquid holdings and make some cash available to pay those investors who want to leave. Woodford then issued a statement saying he was extremely sorry after suspending the trading and explaining the move was necessary to protect investors' interests. One big investor who had wanted to get their money out of the fund was the Kent County Council Pension Fund, and they've got a £263 million holding in the fund. After deciding to pull out the investment, they discovered that trading had been suspended and they were tied up in the fund for the foreseeable future. Paul Carter, who's leader of Kent County Council, told the BBC the money invested in Woodford represents about 4% of our total pot of £6.5 billion of money invested. Hopefully we will get our money out with no reduction, but that remains to be seen. During his apology statement, Woodford said, "As difficult a decision as this is, it's clearly frustrating for you, our investors. We felt it was necessary to protect your interests." Now, there's a few issues to unpick here. Firstly, from a regulatory perspective, the Financial Conduct Authority appears to have been keeping a close eye on this situation. They issued a statement this week to say the FCA's rules provide for suspension in dealing in the units of open-ended funds where, due to exceptional circumstances, it's necessary to protect all the investors in a fund, and the suspensions are recognised as a legitimate tool internationally via IOSCO guidelines. The FCA said, "We expect all firms involved to uphold their obligations to act in the best interests of all investors and to ensure the fund's assets are sold in an orderly manner. A suspension should last no longer than necessary to allow the fund to build up sufficient liquidity to meet redemptions again." The FCA also commented on the decision to list some of the unlisted shares on the Guernsey Stock Exchange. I said earlier that raised a few eyebrows when it happened. And they explained it has been deemed an eligible market by Link Fund Solutions, who are the fund administrators behind the fund. According to their statement, the FCA was not informed and would not have expected notice of any decision to list the fund's assets prior to their listing. So that's the first point to address. The second point is, how did a relatively new fund provider with relatively new investment funds attract £10 billion of investor money in one fund and £800 million of investor cash in another? And looking back at the press commentary around the time of both fund launches, it's just extraordinary. The media, I think, had a big role to play in hyping up Woodford. The BBC even referred to him as Britain's very own Warren Buffett. In June 2015, the BBC ran a profile piece about Woodford, and it had the headline, "Neil Woodford, the man who can't stop making money." That's just extraordinary. Quoted within that piece was Mark Dampier, research director at fund supermarket Hargreaves Lansdown, and Mark said he's arguably the best fund manager of his generation. Now, I mention Hargreaves Lansdown because they're another organisation that arguably played a pivotal role in Woodford's success. Back in March, it was reported that the Bristol-based firm, who are a FTSE 100 firm, they've got 1 million clients in total. They apparently generated a third of the assets channelled to the investment managers' funds. That was reported back in March. Hargreaves Lansdown said in a statement this week they've been speaking to Woodford for some time about the number of unquoted and hard-to-trade companies in his portfolio. They said, "We have encouraged him to address these issues, and he made a commitment to reduce this part of his portfolio in March. Now he has time to do this without also having to manage fund flows." So that statement suggests a trading suspension is a positive move for investors. It's giving Woodford time to work out his unquoted and illiquid holdings before resuming trading in liquid quoted funds. There has been some criticism this week of Hargreaves Lansdown for doing so much to promote Woodford's funds to such a great extent, featuring LF Woodford Equity Income within their Wealth 50 Best Buy list. They've since removed the fund from this Best Buy list, saying when any fund changes dramatically in size, if a fund manager changes their process, or indeed if a fund is no longer available to investors, then we have to review our position. Hargreaves Lansdown have also taken the decision to waive their charge to hold the Woodford Equity Income Fund while dealing is suspended. They're calling on Woodford Investment Management to do the same thing too. Shares in Hargreaves Lansdown have fallen by around 14% since the suspension was announced. That's wiped £1.6 billion off the market capitalisation of the UK's biggest stockbroker in just 3 days. The third point I wanted to touch on when discussing this subject is trading suspensions like this are not completely unheard of. They are very rare when it comes to equity funds, funds like Woodford Equity Income, but they're slightly more common in the commercial property sector. So following the Brexit referendum in 2016, we saw trading suspended in a number of UK open-ended property funds. And this happens when fund managers need to balance demand for investor withdrawals with the availability of cash within the fund. It's what has to happen when you combine relatively illiquid holdings. So a big commercial property, for example, is quite hard to sell. In the case of Woodford, unquoted shares, unlisted shares. And you have to balance that with the ability to buy and sell units in an open-ended investment fund on a daily basis. Illiquid holdings like commercial property and unlisted stocks are probably therefore better suited to closed-ended investment companies, investment trusts. And that's because in underlying investments, underlying assets in investment trusts can stay invested. The share price then fluctuates based on investor demand, so it generates a premium or a discount to the underlying net asset value. A lot has been said and written about over the last few days about active fund management and star fund manager status. Many people have suggested that it's a fool's errand to invest money with a stock picker like Woodford. Now, despite this debacle, I'm not inclined to agree with that view. There is a real and a growing role for passive index tracker approaches within fund management. And that's why index tracker funds are growing. It's still a relatively small proportion, but they're a growing sector, part of the UK investment sector. But active fund management still has a role to play within a well-diversified, carefully constructed portfolio. It's a case of choosing genuinely actively managed funds, not closet tracker funds that hug a benchmark and charge you high fees for the privilege. So in doing so, you need to look for funds that have a high active share. And of course, look out for things like liquidity of the underlying holdings. It's rarely, if ever, a good idea to invest in a fund which holds unlisted shares or private equity, anything like that. And the last high-profile example of things going really badly wrong for investors in a fund that held private equity and unlisted shares was a firm called Arch Crew. Choosing suitable investment funds should never be about the star status of a manager, or indeed their previous ability to shoot the lights out with their returns. Yeah, as we always say, past performance is no guarantee of future returns. Instead, look for funds that do what they say on the tin. Funds that deliver consistent, risk-adjusted returns. Funds with a low cost. Now, before I wrap things up for this episode, I wanted to refer back to a blog post I wrote in May 2014, and it had the headline, "Why I'm Not Backing Woodford Equity Income." So here's what I wrote back then. Unless you've been living in a cave on Mars for the past few months, you're probably aware that investing legend Neil Woodford is due to launch his new fund on Monday. CF Woodford Equity Income opens to new investors on the 2nd of June and will be initially offered at £1 a share through until the 19th of June. Of course, this is not like an initial public offering where investors need to rush to invest. As an open-ended fund, where the price of units will be driven by the value of underlying assets rather than investor demand. With plenty of personal finance journalists fawning over the ex-Invesco Perpetual Star fund manager, it's important for investors to take a step back and carefully consider any decision to invest. I, for one, will not be backing the new Woodford Equity Income Fund at its launch, at least until it's established a track record on its own right. Why? There are plenty of reasons. I've no doubt this is a fund which is going to grow too large. Woodford has already secured institutional mandates reported at over £4 billion from the likes of St James's Place and Hargreaves Lansdown. With some corners of the financial press keen to promote Woodford at every possible opportunity, no doubt hordes of retail investors will also be keen to hand over their cash from next week, swelling the coffers quickly. Remember that Woodford will then need to invest this money in the UK stock market, a stock market which is currently near its record high levels. We were always reluctant to recommend his Invesco Perpetual funds in their final couple of years due to capacity concerns and the risk that moving positions could influence markets. There is also a matter of cost. CF Woodford Equity Income is priced at 0.75% per annum, which is pretty much standard for the clean price of a UK equity income fund. You can get the funds slightly cheaper with discount brokers who have negotiated a slightly lower price, but of course you would need to consider their platform costs, which can make the overall cost of investing higher despite the discount. With Woodford taking what some might call a boring approach to portfolio turnover, investors could be better off with a lower cost tracker fund than paying active fees for Woodford Equity Income. It will be very interesting to compare the performance of CF Woodford Equity Income and, say, Fidelity Index UK Fund with its ongoing charge of 0.07% in 10 years' time. Resources are another important consideration. Woodford has moved from the global company Invesco Perpetual to what is effectively a startup. Regardless of having built a team of experienced people who have worked together in the past, it takes time to gel as a new team and discover what works. Given the size of the mandates they've already secured, Woodford Investment Management will no doubt be able to secure resources comparable to Invesco Perpetual in time, but a new business of any scale is still a new business. If you're desperate to invest in CF Woodford Equity Income from the start, there is probably no harm with allocating a modest amount of your investment portfolio to the fund, but a good rule of investing is to watch out for the hype and actively avoid it. With Woodford, all we've seen now for several months is hype. This is a well-oiled, super slick marketing machine at its very best, securing glowing press coverage and convincing several discount brokers to pump out promotional material on its behalf. Investing should not be about hype. It should be all about what is right to meet your investment goals and objectives. Glitzy fund launches and personal suitability feel miles apart from each other, in the opinion of this advisor anyway. So that's what I wrote on our blog on the Informed Choice website all the way back in May 2014. I also found a comment that I gave to FE Trustnet back in February 2015, where I said, whilst Woodford has delivered some outstanding performance in the past, he is not a magician, and the same rules of risk and reward apply to him as any other investor. So that's it for me for this episode. A good rule of investing is to watch out for hype and actively avoid it. When the press and investment brokers and restricted advisors and others are hyping up a fund, it's no bad thing to be a bit like Neil Woodford, be a contrarian and do something else altogether. I would, of course, love to hear your thoughts on anything I've covered in this episode. Where do you stand on Neil Woodford and Woodford Equity Income? You can get in touch via our website, that's icradio.co.uk. Email me, martin@icfp.co.uk, or get in touch on Twitter @martinbamford. If you enjoy listening to Informed Choice Radio, do take a moment to leave us a review on iTunes. It just takes a minute. That's all for this episode. I hope it's been useful and interesting. Until next time, I'm Martin Bamford, and this is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow.